Hi everyone, it's Alex here at S&P Capital Research. Welcome to our webinar today titled Will the S&P hit 7,000 in 2025? I'm going to use the opportunity to run through just a little bit about my business, S&P Capital Research, and then look at our equity index outlook for the rest of the year. We'll talk about the S&P, and we'll also talk about the NASDAQ a little bit as well. So broad agenda, and then we'll just go over to the shared slides. We're going to run through a brief disclaimer. I'm going to talk about factors that we see driving the equity indices, the S&P and the NASDAQ in particular. Then we're going to look at how far do we think that the indices can go. Now, all of our webinars we run on a live and open mic basis. So once I've done the disclaimer, I'm going to open mics, and then anyone has any questions, points, comments, anything at all, just open your mic and shout into the system. You can also use the question function here in the webinar platform, and I'll spot those and read those out. This is a recorded session, so once it's in the bag, we will put it up on YouTube for anyone to watch and comment on that way. Okay, so let's just switch over to our slides right now. Okay, so a brief disclaimer, which is on your screen right now. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at or intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. S&P Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stock, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the author as the webinar's date of broadcast and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of S&P Capital Research. S&P Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Just a brief word about us before we get into the business end of things. So we're an independent SEC regulated investment research business. All we do is investment research. We don't manage money. We don't provide M&A advice or any other kind of financing advice. We're a pure research business. That's a pretty unusual thing. We've been successful. We've been going for a few years now. We have a fantastic, broad and deep bench of super skilled analysts that cover a range of instruments from equities through futures, ETFs, options, really across the board. Best place to find out about our work, head to Cestrian Inc. On X, or Cestrian Capital Research on YouTube, or cestriancapitalresearch.com on the web, and just a brief screenshot of our website there. So have a look around, see what we do. If there's anything you like, do sign up. Okay, let's take a look now at equity index outlook. Okay. It's a pretty febrile time in markets right now. You can see, you see that with, first of all, a lot of price volatility. And you also see it with lots of strong opinions all across social media, across water cooler conversations, all of that. And there doesn't seem to be much of a consensus. There seems to be a real bull and a bear camp. That's pretty interesting to me. When you get strong opinions and you get volatility, first of all, that's a great time to make trading gains. And for those of you who like to use our long, short, hedged ETF method, that's working really well right now. Talk about that on our website. But it's also an opportunity to break out rapidly in one direction or the other, in the bull direction or the bear direction, because someone is badly wrong. And if you look at the opinions right now, I think we can probably tie them up in two camps. Okay, the bears. The bears have, I'm going to call it fear and loathing. Why do I say that? Well, because we have a new kind of administration in office. And whether you agree with their approach, disagree with their approach, voted for them, didn't vote for them, doesn't matter. That's not what we're here for in securities analysis. What we're here to do is try and work out whether equity indices are going to go up or down. The fear and loathing comes because the administration is doing things very differently. They've set off at a pace. They have a cost-cutting agenda. Foreign policy is different to what's gone before. Domestic subsidy, if you like, policy is different to what's gone before. bipartisanship or lack of it is is different to what's gone before. It's all different. When things are different, that tends to cause a degree of fear because people don't know the lay of the land. There's a whole lot of fear, I think, about things like tariffs. People fear them to be inflationary, and all of us have the worry of inflation at our backs because if we went through the 2022 market where inflation moved up, rates hiked in consequence, and the market was hit. It wasn't a terrible bear market, but it was a bear market, and it needed some managing if you were long equities. So people are worried about that. People are also worried about the general hit to the economy if the government spends less. It's not rocket science to say that a lot of the money that comes into the economy is the federal budget. And so there's a concern that says, well, if that slows up, does that mean less money in the economy? If less money in the economy, that must be bad for stocks, right? So the bear camp tends to, I think, pin its opinion to things in the real and tangible world. And it tends to be pinned to the change in nature of the incoming administration. That's understandable. The bull camp, I think, goes something like this. If you take a step back and put your own personal politics aside, we have a really busy chat room in our service, and one of our golden rules, and has been for years, is no personal politics. Politics matters to stocks, of course it does, but personal politics, it's irrelevant to securities analysis. It doesn't matter what you think or feel. All that matters is, can you call the direction of stocks correctly? And if we put personal feelings aside, be it euphoric, deeply worried, or somewhere in between, you'd say the following things about the incoming administration. First of all other things being equal, corporate earnings are likely to rise. Why is that? Because regulation is being dialed back. So I think the prime example of that is Meta Platforms that already cut swathes of cost from fact-checking teams and DEI hiring approaches. Again, agree with it, disagree with it, doesn't matter. Fact is, they cut a lot of costs out of the business. So all other things being equal, Meta's earnings will be up. And you see that across the board right now. In addition, one would expect environmental regulations, labor regulations, a whole bunch of other things to be reduced, not increased under this administration. And all of the things being equal, that's good for corporate earnings too. So the regulatory environment ought to be favorable to earnings. And again, all of the things being equal, earnings up, equities up. That's not a linear relationship. It doesn't always happen. But if nothing else changes and earnings rise, then stocks are going to rise. Let's look at liquidity. Okay. You could argue, I think with some conviction, that if the federal government spends less, then there is less income coming in for federal employees. They have less money to spend, and that will hit corporate earnings. That's a fair argument. On the other hand, what the administration looks to be doing is enacting a large tax cut. And that means less liquidity will be drained out of the private sector by way of taxes. And probably, if I had to guess, I would say that the tax cut will benefit asset holders more than it will pure labour providers. And therefore, there's likely to be more liquidity finding its way into risk assets as a result of tax cuts. In addition, cost of funds. Now we can come up with a proxy for this, which is the 10-year yield. 10-year yield, as you know, has been hovering in the 4 to 5% range for some time now. And the current administration has said that they intend to bring that yield down. Now that's a very difficult thing to do. It's easy to say, difficult to do. I have no idea if they're going to achieve it. I don't know how they're going to achieve it, but they certainly intend to. So they've made noises about the use of the draining the Treasury general account. It wouldn't at all surprise me to see some form of QE in the coming months and years, but we can expect them to try to drop the 10-year yield. And if the 10-year yield drops, it means two things. First of all, the cost of money, if you like, the cost of funding risk assets falls because leverage cost falls. And again, if this tax cut is enacted, then my guess is that provides more liquidity than is drained from the withdrawal of income for however many federal workers no longer work for the federal government. Finally, technicals. I'm going to look at some charts in a minute because technicals in the end comprise all these things. Technicals look bullish. They look set up bullish to me. Now, we can all make bull and bear arguments from looking at the same chart. We can make a bull argument to ourselves, a bear argument to ourselves. If we're doing our job right as analysts, we'll do bull and bear every minute of the day, all day long, always considering the opposite argument. But stood back and looking at a distance, technicals look bullish. Let's look at the S&P. So I'm going to look at the SPY ETF by way of a proxy for the S&P. So if we think about S&P, SPX 7000, that's around 700-ish on SPY. So let's just take a look and see how that's looking. It's going to get this on your screen right now. So this here is a monthly chart of the SPY ETF, and we use this chart all the time in our work, have done for years. Chart doesn't change. All that happens is time passes. This here is the COVID low with SPY at 220. This here is the bull market high in the end of 2021. Around 480 was the top here. We saw a 50% Fibonacci retracement down here, meaning the share price change here from the COVID lows to the bull market high, about half of that was lost down into the October 22 lows. We had a 352-ish low on the SPY. Now, ignoring all the things I've just talked about in the real world, and if we just look purely at pattern recognition, the pattern recognition system we use, Elliott Wave and Fibonacci's, there's all different kinds of systems, but we like this one, it works for us, suggests that about the earliest this bull market would terminate would be around 612 on the SPY. Why? Well, because it's the 100% extension of this wave one placed at that wave two low. Why does that matter? Well, because we had a big bull market here from a really critical, reversal low here. Everything changed in the world down here. Federal funds flow changed here. Massive option expiry here. The rehedging flows of which was a catalyst that came in. The tsunami of federal money was the big accelerant that drove this wave up, and then the subsequent inflation and rate hikes, as we know, pulled the market down. Having bottomed out in October, we then get this move up, and this 100% extension stops at 612, and it's not coincidence that that's been the all-time high so far. So we'd said for some time in our work that 612, let's call it 6,100 on the SPX there and thereabouts, would be about the earliest you'd expect that bull market to terminate, and maybe it has. In December, January, and February so far, the S&P has tried and failed to break through this level. So perhaps it's going to fail to do so. We're going to roll over and we're going to be into a bear market. Now that could be, obviously, it could start tomorrow, it could start in a minute, but that's not my best guess. My best guess is that we're going to complete a standard extension here. And I think that we're going to see the S&P move to at least 673, which will be the 1.236 extension. That's about 6,700 on the SPX. And my best guess is we go beyond that. And my best guess is that we probably can make it to 7,000 on the SPX, 700 on the SPY. I don't know it'll happen this year. I'm pretty sure it won't go up in a straight line. I do know that if it happens, it's going to be another hated rally. If you think about the general sentiment there's been towards this rally from the October 22 lows, if you spend any time at all on social media, you'll know that you've had people decrying this rally from the off and therefore failing to take part in it. And I personally think there is earnings upside ahead. I think there is liquidity upside ahead. I think there is pro-market administration in place. And I think if you put all those things together, then for now, I think we have the SPX moving up and taking the SPY with it. Now, nothing lasts forever. And as sure as we've had this new bull market, we'll definitely have a new bear market. And the thing we focus on in our work is making sure we call that correctly. And so looking at, where is the market likely to roll over and what should one do about it? So it's possible that the S&P has topped. It's definitely possible. We've had 3 months now where it can't break through this 612 level. That's a characteristic of a market topping out. If you look back here in 2021, in December and in January, in fact, in November, December, and January, it couldn't break up and over around 480. Tried and couldn't, and then we know what followed. So it's possible that this 3 months here is marking a top. And the thing we always do in our work is say, well, okay, we think it's going to carry on, but if that's a top, now what? So we teach the art of hedging in our work, which is, if you are long SPY and you're concerned that you think that the S&P is going to sell off, but you don't want to take profits at this stage because it might just carry on, we show you how to use inverse ETFs like SH would be a 1 times inverse ETF. If you'd like to use the levered long ETFs like UPRO for the S&P, we teach you how to use SPXU as a hedge on the downside. That's the 3 times equivalent. And this can be used intraday for short-term profits. It can be used over the course of a week or a couple of weeks in the event of a market sell-off, as we saw back in July to October 23, as we saw in April this year, and as we saw in December this year. Or it can be used longer term as and when we enter a bear market, which at some point we will. We will see a big drop in the S&P at some point, and we just have to be ready for it. I'm going to just switch microphones on now, so that if anyone does have any questions or comments or anything, they can speak up. And also, mics are on now, so if anyone has questions, do shout out. I'm also going to move on and look at the NASDAQ by way of the QQQ ETF. Now, this here is the weekly chart. And this again starts at the COVID lows. Again, let's rehearse. Why start at the COVID lows? Because everything changed. Because there was a genuine fear that the world would sort of stop and break. Lots of prices broke. The oil price broke. The S&P and the NASDAQ sold off hard. But what happened was, again, 2 things. People were so bearish coming into March quarter end in 2020 that people had bought so many puts that when those puts expired, many of them not in the money, the re-hedging flows, the buying by market makers of the underlying equities that they'd hedged out, caused a small market reversal in itself, and that was then accelerated by the huge influx of federal money. And this is my point on liquidity. The reason that an influx of liquidity into the market drives asset prices up and causes inflation is because a surplus of liquidity typically flows to people who have money. So some of the liquidity that's injected is used by poor people to buy food, but most of it ends up in people's pockets who already have enough money. And what they do with spare money is put it into securities markets. So if you add liquidity to the system, be that via the Fed actually sending people money, or by draining the Treasury General account, or any other form of government stimulus, of which there are many, then generally speaking, a lot of that cash ends up in risk assets, therefore it drives them upwards. This is the QQQ ETF here. 168 was the COVID low here, shot up to 405 by the end of the 2021 bull market. And then we had this sell-off deeper than the S&P. It was a 61.8 retrace in this Fibonacci scheme. Tested that from October the 10th all the way through until January the 2nd. That's October the 10th, 22 to January the 2nd, 23. Found that firm support down there and then shot off to the upside. Now, the NASDAQ, as you can see, is further ahead than the S&P. Okay, we'd said that the S&P had stuck at the 100% extension. So if this was an S&P chart, you'd say it can't quite break 492 yet. And so perhaps the 100% extension is all we're going to get, and we're going to enter a bear market. Well, the NASDAQ so far, in the QQQ form, has shot up to an all-time high of 538. And it did that back in the middle of December. It hasn't been able to retake those gains yet. 549 is an important level. It's the 1.236 Fibonacci extension of that wave 1, placed at that wave 2 low. And so, again, it's possible that because the NASDAQ can't break up and above this level so far, it's tried in December, January, and a couple of times in February now, perhaps that's all we get in the bull market, and perhaps it rolls over and sells off. That's not my opinion, but it's possible. And again, in our work, we can show you how to use inverse ETFs like PSQ, which is the 1 times inverse of QQQ, or SQQQ, if you'd like to use the 3 times long TQQQ. We can teach you how to use those to offset and try to gain from any short or long-term market weakness. My best guess in the QQQ is we're going to see at least 549, 550, which will be this 1, 2, 3, 6 extension. Remember, the equivalent in the S&P was this level up here, 679. Just going back to the QQQ right here, if you push me, I'd say I think there's every chance the NASDAQ can get to 640. The angle of attack, if you just take a very simple, sort of line of best fit, if you like, and you look at the rate at which price is climbing, if we're going to get to 640 on the NASDAQ, if we're going to get to 700 on the SPY, I don't think it's quite going to happen this year. I think it might take a little bit longer. And again, I don't think it's going to be in a straight up line. But my guess is that the market is set up to be more bullish than most people think. And I think the danger is in convincing oneself that that's not a possibility because of all the change that's going on in the world, of the foreign policy reverberations that are knock-on consequences from the new administration. I think it's really easy to think, well, this is a different environment. I'm worried, stocks can't go up, and that's, I think, an incorrect assumption. That might prove true, but just because one feels it, one sees difference, doesn't mean the market can't go up. And so, as always in our work, what we do is we focus entirely on price and volume, and we ignore all of the noises off. We recognize that policy changes impact securities prices one way or another, but we don't try and draw a line directly between if this happens in government, then that must happen in securities. We follow price and we follow volume, which has served us really well through bull and bear markets alike. Okay, that's all I plan to cover today, really. But if anyone, again, has any questions, comments, anything at all, now's a great time. If not, then I'm going to just show you how you can get hold of more of our work. So I'm going to put this back on the screen here right now. So how to get our stuff. You can find our work on X at Sestrian Inc., on YouTube at Sestrian Capital Research, or on the web at sestriancapitalresearch.com. And if you have questions, anything at all, then there's a contact form on our website. If you scroll down, there's an Ask Us Anything button. You can reach us by email at minerva@sestriancapital.com, or again on X at Sestrian Inc. And of course, when we post this on YouTube, if you're watching the recording of this, you can always post comments in the video section, and we'll come back to that as soon as we see them. So it remains to me just thank everyone for watching. Hope you enjoyed the webinar and found it useful. Reach out if there's anything else we can help you with. Thanks a lot, folks.